start recording. Oh, there it is. I see it. Perfect.
Excellent.
Good to go.
All right. So good evening, everybody. Thank you for joining us and taking the time out of your very busy schedule. For those of you who don't know me, my name is Lawrence Searle. I've been an investment advisor running my own practice for the last 26 years. And my practice is always focused on process planning and bringing the best-in-class resources to help my clients achieve their goals. Everything we do within the practice has a tax focus because it just makes sense. For those of you who aren't familiar with Richardson Wealth, we're a publicly traded Canadian firm with about 165 advisors managing approximately $34 billion in assets. Tonight's presentation is the second of a three-part webinar series I'm very proud of, designed to help incorporated professionals to get the most out of their professional corporations. The goal of the series are simple. Number one, to educate you, the audience, and number two, provide some insight to the tremendous resources that I'm able to make available to my clients. The first webinar focused on the ins and outs of a professional corporation from a tax perspective, and tonight we'll be focusing on connecting your professional corporation with a personalized wealth plan. Our third webinar, this is the promo part, will be on November 23rd next month, and will be focused on tax-smart investing inside your professional corporation. My guest speaker tonight is Maureen Glenn. Maureen is the head of our tax and estate planning department at Richardson Wealth, and she's been an outstanding resource to my practice and to my clients over the years. Maureen, I'm going to ask you to give us some insight into your impressive background before we start into our presentation, so I'm going to hand it over to you.
Thanks so much, Lauren, and I hope you can hear me okay.
Yes.
I'm going to apologize for my gravelly voice. I have a bit of a cough, which is kind of long COVID. I am better now. Trust me, I'm fine. I'm just going to cough my way through. But without the visuals, please bear with me. So thanks very much, Lauren, for your kind introduction. I do lead a group of professionals at Richardson Wealth that can collaborate and make available the kind of consultative services that our high net worth families need. We've learned over the years that most of our clients have great tax accountants, have great lawyers for tax, for corporate, for transactions as needed, even for estates. But often those professionals do not interact with each other. And as we know, going through life, you need a plan, and you need for all of the pieces of your puzzle to speak to each other. So we find I'm a trust and estate practitioner by practice, and I'm not a lawyer or an accountant, but I have some wonderful lawyers and accountants on my team, along with certified financial planners who can pull all of those pieces together and make them make sense. So that's my short commercial for what the Tax and Estate Planning Group does. My personal background, as I said, I'm a trust and estate practitioner, a certified financial planner. I spent many years in the insurance industry before joining Richardson Wealth 16 years ago. So I think I'm one of the longer employees with the firm, and proud to be so. So with that, Lauren, why don't you kick us off?
So tonight's topic is connecting your professional corporation with a personalized wealth plan. And really, it's all about understanding the importance a wealth plan plays into being successful with your professional corporation. A lot of people know it's the right thing to do to incorporate because they are saving more than they're spending, but sometimes they're not digging deep enough to get the full value out of their corporation. And if you don't plan in advance, there are exposures that will cost you more than you would think down the end of the line when your estate is involved. So again, this is the second webinar in a series of three, and please continue on, Marie.
All right. Perfect. Sorry, I should have had that slide up sooner.
That's okay.
So this first slide is really about some of the critical questions that we feel are important for any incorporated professional to consider. As I said, you probably have a great tax accountant who can help you minimize tax, think about ways to plan and strategize for the corporation, your professional corp. However, we also need to think about it from a personal standpoint and from the family. How can I minimize tax now and in the future? Let's face it, in Canada, it's simply wise to plan to minimize tax because we're in a high tax regime. What's the best way to plan for my retirement? We get this question all the time, and we'll talk a little bit about how you pay yourself from your corporation. and how you can ensure a successful transfer of wealth to the next generation. And this is where the family comes in, and we'll talk more about that. But most importantly, what are the risks to my family wealth if planning isn't prioritized? And I'm sure any of my team, and I'm sure Lauren can even share stories where we've seen families struggle at different points in time during their careers and at death, and wanting to make sure that we can avoid the risks or mitigate them at best. Incorporated professionals have some exciting planning opportunities that can help, but they're complex and we don't always understand them in great detail. Hopefully we can help pull the pieces together. So you're looking at our planning wheel that you probably have seen this before. The wealth planning process is an ongoing thing. Lauren does an amazing job in his practice of identifying risks and opportunities with regards to the families that he works with, then he can draw in the services of my tax and estate planning team as an extension of his team to ensure that we are educating on some of the more complex planning strategies, identifying those that make the most sense in your family and professional situation, and then helping to create an action plan to implement the solutions. You know, I had two spouses, they were lawyers, and we did planning for them about 5 years ago. Very complex plan. I'm sure many of you have that situation where you've got professional corps, you've got multiple corps, you've got multiple shareholders, perhaps in different types of corps. You've got different investments, TFSAs, RSPs in your corporation, and so on. And when we did the planning, it was a very complex plan, and we spent a lot of time educating the clients. 5 years later, they came back to us and they said, "That was great. We didn't actually implement anything you suggested. Could we start over again?" And, you know, we kind of felt frustrated at the time because it was, you know, we did all this great planning, but for some reason we were unable to get this family to implement the solutions and the strategies we were suggesting. So I think implementation and the action plan are absolutely critical. That's that implementation and review. Implement some of the recommendations that make sense today, and then review on a regular basis to ensure that your family logistics, everything changes over time. We need to ensure that when it actually gets to the point of transfer of wealth, after you've accumulated it to the next generation, that we're ready for it, they're ready for it. We'll talk more about that in a moment. So what really are the risks for not planning? I think for our business, we do a lot of planning, but often personally, we tend to procrastinate that. So first of all, the biggest risk is paying too much tax. If tax is not your thing, I'm sure there are some participants on the line who are tax professionals, and they know that they're doing the planning they need to around tax, but not everyone is. I've met lots of other professionals who tax, it's just not their favorite subject. We can help. Missed corporate planning opportunities. Your professional corporation provides you with some specific strategies that may be understood or a lack of understanding. And without good planning, unfortunately, long term, we can see family disharmony where communication has not been present. I worked with a family recently where the patriarch had built the business, had built his professional corp, had saved lots of money, had minimized tax, done everything right. But then he passed on and he failed to educate his next generation on how they could keep that wealth and the legacy going. He perhaps didn't allow for the longevity of the legacy he had built. Absolutely most important, a risk of wealth erosion is estate litigation. We should do everything in our power to minimize the risk of going to court. We have seen in Canada, and maybe Canada is maybe a little less litigious than other jurisdictions, but we are seeing more and more where there is money on the table, there is wealth in an estate. If there's a disconcerted or unhappy beneficiary, there's the risk of legal action, and that will erode the wealth of the family and the estate for sure. So we need to minimize that. I can give you a few tips on that. And financial predators. So this is maybe, it seems like a smaller issue. However, for the elderly in Canada, I believe it is a risk. I believe we are a proud society. We are private in many of our financial dealings. We don't always ask for help. And where An individual is now the survivor of a family, perhaps a widow, widower. They don't have the family network around them locally that they can rely on. They could be at risk of what we call financial predators, or perhaps individuals who are going to take advantage. So they need to have trusted people around them. I know Lauren does a whole other session around trusted contact people. So I'll leave that to Lauren's other session.
And I'll just mention in my library, we did a presentation on why estate planning should be a family affair and why it's important to be a family affair. I also did a presentation on fraud prevention, which is interesting if you are involved with elder care or you're getting on in years. So there's some good resources on my YouTube channel.
Absolutely. And I love that you're building that library of information, Lauren. So let's talk about planning specifically for incorporated professionals. I understand there's some attendees tonight who are professionals who have incorporated their practices. And I would say without a doubt, all incorporated professionals can benefit from a wealth plan. Often you would be approached early in your career to set up a plan. And that might be as minimal as opening your corporation, starting to flow your income through the corporation, deciding how to pay yourself, starting to save to things like tax-free savings accounts and RSPs. That's the initial planning phase. But remember that every year throughout your lifetime, your situation changes a bit and there are trends. So to ensure that we don't miss any of the gaps or opportunities, proper planning can improve the situation. And that's not just about tax, it's about corporate structuring, which I think is misunderstood, especially for professionals. How do you plan for your retirement income when you choose to stop working? How do you plan for your estate? As Lauren mentions, I do a whole session just on estate planning, but we'll touch on a few of the key issues around your corporation as well. Insurance planning, often misunderstood, can be a very valuable tool. Lauren and our team will delve into that more in the next session of this webinar series. And most important in my mind is preparing the family for the future. That's the education piece. That's making sure that your children are raised in a way that they understand the wealth and they can act on it when the time comes that the wealth is passed on. The plan's going to evolve over time. Follow up and review is important. We cannot assume, and I say again, often as professionals, you will receive support and advice from individuals in your early career, and then you may not hear from those individuals for a very long time. You might set everything up perfectly, but as you move through your career, as you go through the building and the growth and the accumulation part, you finally retire. Now you need to decumulate and start to draw on your assets to provide for you and your family in your retirement, happy retirement. So each stage of that planning is important. And all of these pieces are intertwined and form a part of the full impact of your success. Wouldn't it be nice at the end of the day that you can be proud and see the legacy that you've left behind? So let's take the first part. This is the part we get the most questions on, especially for active professionals who are running their corporations today. They're earning money, they're in the accumulation phase, but they're anticipating a retirement down the road. I'm seeing, of course, the baby boomers are moving through retirement right now. So we're getting lots of questions around retirement income, but there's a whole bunch of planning we can do early, midterm, and into retirement to make sure that you have the retirement you choose. The first step, how do you pay yourself? So optimizing the compensation that comes out of your corporation with planning. My team does some thought leadership pieces. We have education articles around this specific topic. Why would you pay yourself a salary or a dividend from your corporation, or perhaps a combination of both, and why? We can do this analysis for you, and we can compare different scenarios. I delivered a plan just 2 weeks ago to a family in Winnipeg where they had chosen to pay themselves a very large salary, the professional, a very large salary from the corporation, because he knew that after tax, that was the amount he needed in cash flow to pay for his family needs, his mortgage payments, his lifestyle, his travel, and so on personally. When we actually played with the numbers, and I can show you how we can do these comparisons, we were able to show him that he could actually reduce the amount of salary income from his corporation increase the amount of dividends he was drawing from his corporation, and reduce his personal tax level, as well as gaining some benefit within his corporation. All around, a better tax situation. So there is no one right answer. It depends on how much you spend, what your lifestyle looks like, how much you earn within your corporation, how much can you leave within the corporation for tax deferral. If you were on the first session of our series with my friend Sean Sue, you would have heard about the difference between earning money within the corporation and the tax deferral opportunities that are there. So how do we maximize tax deferral within the corporation while also ensuring you can draw enough cash flow out, either in salary or dividends or a combination of the two, to pay for your lifestyle? So what's the benefit of a salary? Well, it's tax deductible for the corporation. So it reduces the amount of tax on the active business income right up front in the corporation. However, you're going to pay a higher personal tax amount on the salary. You do have the ability to fully utilize CPP contributions and RRSP planning. So you can contribute to your registered retirement savings plan, as well as your annual CPP contributions, which will create some income in your retirement. Now, something that is less used and less understood is called an individual pension plan, an IPP. In other circles, it might be called a PPP, personalized pension plan. This is an opportunity for incorporated professionals. It doesn't exist for everyone. It may or may not fit for your situation, but it's something worth exploring depending on how much money you're leaving within the corporation and how much you're saving for retirement. And after retirement, income splitting, or sorry, even before retirement, income splitting may be possible with the payment of salaries as long as they're reasonable. Now, it depends what kind of profession you run, what your professional corporation is set up as, and what the rules are within your province for that professional incorporation. But in some cases, you may be able to pay a spouse or a family member a reasonable salary, which is a little bit of income splitting for the contributions they make to your work. So what are the benefits of dividends? This is the flip side. Well, for one, when you pay yourself a dividend from the corporation, you pay a lower tax rate on that dividend, dollar for dollar. But it's not a deduction for the corporation. So you take the dividends from the corporation after the corporation has paid its tax on active business income. You do have the flexibility for timing the outflows from the corporation as needed. So perhaps you pay yourself a regular salary, which pays the regular bills. And at the end of the year, you decide to take an extra chunk in dividends for a specific travel, vacation, whatever that might, gift to the kids, whatever that might be. So the dividends allow you lots of flexibility of timing and the amount that you can draw. Along with that, there is the opportunity of the capital dividend account within a corporation. This is a complex construct. I'm not even sure that Sean covered it in his previous session, but a capital dividend is created when you sell investments in the corporation that have realized a capital gain. So the 50% of the capital gain is taxable in the corporation. The other 50% is not taxable and can actually flow out through this notional account called a capital dividend account as a tax-free distribution to the shareholder. So in that situation where you've run your corporation for a long time, you've acquired investments within the corporation as a tax deferral strategy, you choose to sell capital shares within the corporation. Perhaps you invested in, I don't know, Bell Canada or any other blue chip type stock. You might realize a capital gain, and there is an opportunity to flow tax-free cash out of the corporation into the shareholders' hands when you do so. Now, you need a good tax accountant to help you with that planning. It's a bit of a timing issue, but it's a great opportunity to harvest tax-free cash from the corporation.
And I like to,
Sorry,
I was
go
going to
ahead.
say, I'd like to interject that there's a lot of interesting and useful topics here that we're going through. And one of the biggest advantages of working with our firm is that the wisdom, because they see so many high net worth plans. It doesn't take long to recognize whether there's an opportunity for an IPP or whether there isn't, or whether you should dive deeper into other areas. So it's something that if you're working on an island, it's not so obvious, but when you're working in this area on a day-to-day basis, there's a lot of wisdom to impart to our clients. So there's a lot here, and like I just want to make it clear that we're able to get to the nitty-gritty of it pretty quickly when we see the profiles.
Absolutely. And I think it's also important, Lauren, to mention that there's no right answer for every family or every professional. We really need to look at your personal, unique situation and then address what opportunities fit you
Exactly.
and your family. So, for example, one of the benefits of dividends, which has been a lot in the news over the last few years, you used to be able to share dividends across family members in certain situations for certain professionals and split the income in that way and reduce your taxes. Now, they shut a lot of that down, but I can say that where you may have a spouse who's a non voting shareholder in the corporation, you may still be able to share those dividends with that spouse when you're over the age of 65. So that was the government's way of saying, okay, we're going to shut down some of that income splitting opportunity that was there before, but now that you're over 65, we want you to support your own retirement so we can help you by reducing your tax bill. Again, depending on your family situation, depending on your personal cash flow needs, we can identify which one of these items make most sense to you, or maybe a multiple of them, and then drill down to how do we make that plan work for you.
Excellent.
So very, very briefly, an IPP, complex concept. It's really your very own pension plan. It's a defined benefit pension plan, just like the Bell Canada employee. I'm picking on Bell tonight. Bell Canada employees have in their world. You can create this within your own corporation. It needs to be created and administered by an actuarial firm, but we can help you with that. So Lauren can act as your quarterback in identifying, is this a good opportunity? How do I make it work? Salaried income is required to make it work. But this is something that we can certainly drill down. We do a whole session separately on this topic. So that addresses some of the planning opportunities available from your professional corporation to pay yourself during your lifetime and in your retirement. And paying yourself dividend salaries, we can look at the timeframes and the horizons and the amounts required and create that plan for you. But I think the flip side of the coin is estate planning opportunities. And I want to spend a little bit of time on this, near and dear to my heart. Why the heck do you need an estate plan? You know, my three children are young and married, starting their families. And my son said to me, "Oh, I don't need a will. I don't really own that much." Well, yeah, you need a will. First and foremost, you need a will. But that's not an estate plan on its own. There's a whole bunch of other things you need to consider. You need an estate plan to ensure you minimize unnecessary taxes and expenses at death, especially at death. Secondly, you need to ensure that your wealth is transferred the way you choose, not the way the government might decide or prescribe the traditional family and how wealth is passed on. You can create a true family legacy by choosing how your wealth is passed on. And of course, that involves the family. Clarity creates family harmony. I come from a family that does not talk about finances ever. When my father died, we really had no idea how much wealth was there, what assets he held. And as a result, it created confusion and a little bit of fear and perhaps some misinterpretation. So, in order to avoid family discord, clarity is important. Many believe the family will just sort things out on their own. I think my father did. I can guarantee they won't. This is what ends up in court cases after the estate or during the estate. If you make sure your heirs understand that you're giving with love and consideration of their wishes as well as your own, you can ensure your kids know that you cared and you made a conscious decision instead of just passing things on and letting the next generation deal with it. But let's talk about your corporation. The professional corporation's tax deferred dollars, remember what Sean taught us in the last session, it has to be managed. Otherwise, there can be significant tax on death. So, similar to an RSP, when you contribute to an RSP, you get a tax deduction. That's great. You get to save long term for your retirement. Wonderful. But when you take the money out of your RSP, you pay tax on it. Similar to your corporation, when you earn money in your corporation that you don't automatically pay to yourself, but leave within the corporation to be invested, you get a tax deferral. Now that means you pay less tax initially, but you're going to pay tax later on unless you do some really great planning. Now, of course, if you leave a surviving spouse, there's always a rollover provision, which allows for the shares of your corporation, the assets within it, as well as your personal assets to be rolled over to your surviving spouse or common law partner, again on a tax deferred basis. But let's face it, when your surviving spouse passes on, the tax bite is going to come. So it recognizes that there are accrued gains and losses. These are taxable income issues on the death of the second spouse, usually. The shares of the corporation are subject to these rules, and I'll talk a little bit more detail on the next slide. So what are the tax issues? Accumulating tax deferred funds in a corporation increases the value of the shares that you own of your corporation that are subject to a deemed disposition on your death or the death of your spouse, if you have one. Often the cost of the shares of the actual cost base of the shares of the corporation itself are nominal in value. So you set up your corporation and you have a share in your corporation worth $10. But over time, your corporation could become worth millions of dollars because you saved in it and benefited from that tax deferral. Unfortunately, there's multiple layers of taxation that can occur. Now, here's a visual. Sean covered this in his session last time, which I believe was also recorded, so you're welcome to go back and look. But there's really 3 levels of taxation if you no longer have a spouse and your corporation is what your professional corporation is wound up on your death. So there's the tax on the shares you own of your professional corporation. There's the tax within the corporation for the investments that are sold within the portfolio. And then there's tax to pull that money out of the corporation into the estate's hands to be distributed. That total income tax rate can be as high as 71% at death. That's a horrible thing. Planning is necessary. So what I want you to hear from this is there is planning available. And if there's any tax lawyers or estate lawyers on the call, they will know this. We call it post-mortem estate planning. And it really can minimize the tax on your corporation with some advanced planning, which includes corporate structuring, as I mentioned before, ensuring you've got governance of your corporation after you've passed, so someone can carry on the corporation if need be. And some very complex tax planning that can be done to minimize this triple tax effect. And it's actively done. It's worth considering. If you're already retired and you have tax deferred dollars invested in your corporation, there are other things you can do even during your lifetime, such as an estate freeze or other planning to ensure that the assets in the corporation can be passed to the next generation and minimize tax on your death. So
I think we're gonna copy over that exact slide to our next presentation next month when we talk about tax efficient investing within your corporation and also how to minimize that what could be 70+%. So
absolutely.
definitely worthwhile checking in there, not to panic because there certainly are ways to minimize that.
Well, and I think the slide is important. That's why I borrowed it from Sean's presentation, because it really hits home that you can't just ignore this. This is a structure the government has set up for us to allow us to help you ameliorate your position as you're earning money and retiring. But there is an impact at the end of the day that we just need to be very wise and planful about.
Yeah, the beginning of Sean's presentation, Sean, just to remind you again, he's our tax specialist within the group. He talks about the benefits of keeping monies in your corporation, getting 85-cent dollars or 75-cent dollars from the money you earn, which is much better than 49% when you take it personally. But part of the challenge is taking that inexpensive money and making sure you're not paying it on the way out.
For sure. Absolutely. It's hard to think about these things in advance when you're a busy professional just trying to earn money and run your profession and run your business. However, having really smart people in your back pocket to help ensure you're not overlooking these strategies is important as well. And for the attendees on the call, you're probably hearing some of these strategies from your peers. I had one lawyer come to me and say, well, my buddy down the street has a family trust. Do I need one? Well, maybe, I don't know. Let's look at your situation personally and figure out what your unique needs are and if the trust structure might work for you. A couple of points, other types of taxation, which you'll hear about in the news all the time. Probate fees in Ontario are very high. Probate is a process, it's an administrative process at time of death that validates that the will that is being administered is the most valid, most recent one. But in some provinces, the fees for that probate process are very high, and Ontario was one of them. And so we often spend a lot of time trying to avoid the probate fees. But we need to make sure that we're not overcomplicating your estate planning just to avoid a 1.5% fee at death. 1.5% is a lot, but as a professional corporate owner, you have the benefit in Ontario of using a secondary will. Again, very complex idea. We can talk more about it, but it's valid in Ontario, and it's an easy way to separate your corporate assets from the rest of the estate and minimize probate fees. Trust planning, as I've mentioned briefly, is another way to separate assets from your personal estate and avoid some probate fee planning. Keep your assets private in nature. And again, it can be done in many, many ways in different levels. Another slide will speak a little bit more to that. U.S. estate tax, if you actually hold any what we call U.S. situs property, which means U.S. stocks and bonds, U.S. Vacation properties, and so on, then you may be exposed to U.S. estate tax, even if you are only Canadian and not a U.S. citizen. Either way, we can potentially reduce the exposure to U.S. estate tax and still allow you to invest in the U.S. markets by utilizing your corporate investment assets. So there is planning can be done to mitigate the taxes. So I've mentioned a few of these topics. I won't go into detail here, but here are some of the tools. This is critical estate planning tools for you, the incorporated professional. Corporate governance is important. If you have non-voting shareholders in your corporation, is an agreement required? Is there a business succession plan? Because you're an incorporated professional, there are rules around who can own a professional corporation during active income earning years. However, there may be planning that can be done either after you retire or with other professionals to help you pass those assets on. Ensuring that you've got amazing legal and accounting professionals available for your heirs so they know who to talk to, someone who's familiar with your situation and can provide what I call postmortem planning at the time that it's required. In Ontario, both spouses, where there's a corporation, should have a primary and a secondary will, even if your spouse is not a shareholder today, assuming they may inherit your shares of your corporation on your death, then they will benefit from having a secondary will as well. Powers of attorney, of course, are very important during your lifetime for property as well as for personal care. Very briefly on trust planning. Again, this is a whole other session. There's two ways you can do trust planning. During your lifetime, which is often a way to sprinkle income across family members for their benefit, even grandchildren in some cases, income splitting and minimizing tax in different ways during your lifetime. What we're seeing a resurgence on is the concept of a joint partner trust or an alter ego trust for those over the age of 65, which minimizes probate and actually allows for an alternate to your will to deal with certain assets. Testamentary trust planning is really the wording that's within your will, where your primary or secondary will identifies that your assets should pass to a spousal trust, a family trust, or most importantly, trust for minor beneficiaries, because children under the age of 18 in Ontario cannot really hold assets. So we need to provide a formal trust structure to maintain those assets and look after them until they're of a real mature age enough to manage the assets.
And it's interesting, testamentary trust used to be a whole different vehicle not too long ago until the government in its wisdom decided to tighten it up in terms of its tax flexibilities. So a lot of people who had wills put together and thought it was all under control 10 years ago really need to revisit for the changes in the tax laws. So that's something
You're
we encourage as well.
absolutely right. And this is again where the tax and estate planning group at Richardson Wealth can help you through Lauren by creating thought leadership pieces. We review the budget every year to find out what the impacts will be to our high net worth families when there's significant tax changes, as there have been over the last 7 to 10 years, as Lauren mentions. These are really groundbreaking tax changes that have occurred, and we need to stay on top of them, and we can help you with that. So communication is key. How do you communicate your estate plan or even your real retirement plan to those around you? We believe that successful wealth transfers occur when the conversation starts early. I believe that silence is destructive, as I've described, and education takes time. I remember a family, a doctor who had accumulated significant wealth in his corporation over time. He and his wife had done some planning, but they had not educated their 3 children. And there was a significant amount of wealth involved. And, you know, the time that dad starts to become ill is not the time to start the education. It takes time. Your children need to mature into the wealth. I believe in having a family mission statement. So what does your wealth mean to you? What is your legacy? Do you support a specific charity? You should communicate that to your family so they understand, you know, why you made the wealthy, why you worked so hard to create the wealth you did, and then how can it be used to leave that legacy for you? Unfortunately, I've been spending lots of time in the hospital with my elderly mom lately, and I see the benefactors on the walls of the hospital, and that's a sign that those families had a mission statement and a plan. You know, if you want to take it to the next level, holding family meetings may be important. And depending on your family structure and the dynamics there, you may want to communicate one-on-one to address those tender issues. You know, there's always one sibling that doesn't get along with the other. There may be one sibling that was seen to be more spoiled than the other. So you need to address those as tender issues. Where you have a larger family and or more assets to deal with, you might want to encourage an actual formal meeting with a moderator to help you work through some of those challenges. Again, we can make sure we find resources to help you do that. Create a strategy to provide not only choosing the right executor is important. I do a whole session on that. Discretion for your executor to make the right decisions within the scope that you've documented. Ensure that corporate governance is resolved and the family is not in limbo trying to decide who has control of the corporation. Make sure there's a way for your heirs to resolve their differences. If you have 2 children and you name them both as the eventual executors when both you and your spouse have passed on, you cannot assume they will get along. They could get into a deadlock position and you need to help them find a way to get through that. The use of a personal memorandum or Tory letter, again, in a previous session, we talk about that. I know Lauren feels strongly about that as a letter of wishes as well.
Yeah, and again, back to the webinar we did earlier about making estate planning a family affair touches upon a lot of these things. And, you know, we had some questions about, do you want to treat your kids equally or fairly? There's 2, you know, it sounds obvious, but there's certainly a lot of innuendo for all the families when they get together. So it's very complex keeping the family together as much as dealing with the tax on the family side. So these are just good heads up that you certainly don't want to neglect.
So the bottom line is, let's create your comprehensive wealth plan together as a team. Working with Lauren, with the professionals at Richardson Wealth, while we do not draft wills or implement the tax situation, we can help to analyze it. And we're happy to have that conversation to listen to your needs and your wishes, and then to help you create that comprehensive plan. We saw this slide before, the wealth planning process. We need to identify the risks and the opportunities, educate the family, educate you and your family on how these strategies can be implemented and be worthwhile. We have to have an action plan to actually make these strategies a reality that can be implemented later on. We need to help your family understand and protect your wealth and the legacy you've built, and ensure the smooth transition of that wealth to the next generation. And we have the ability to help you do this.
I'm just going to interject before we show the next slide, which I like actually. But A lot of
Very
people aren't aware that, within my practice, we're able to bring these incredible resources to our high net worth clients. And a lot of people, they see these presentations and almost think they can't afford to get into it. But the fact is that that Marines Department is all about supporting my practice, and it's a huge amount of value that is complementary. We deal with high net worth clients, and the average client size is well into 7 digits. But importantly, this is not something you have to pay out of pocket. This is part of the complementary services we provide, and it's been part of the practice for a long time. And people say, why are you different from any other advisory firm? And I suggest that our tax estate planning is best in class, and it really can provide a huge amount of value you may or may not be looking for, but it's an important part to get the most out of your professional corporation and your personal finances. So I just want to say that this is all complimentary, as intricate as it sounds. It's a very, very nice feature to have within my practice.
Absolutely. And we try to make the process as painless as possible. When you're ready to start talking about some of these issues, we can help. We can help with the discovery process and understanding your situation through data collection, validate that we understand your situation, analyze the scenarios available to you and present it back, and then urge you to implement and review on a regular basis. And remember too that we can do this on a modular or a comprehensive way. I personally love doing a more comprehensive approach to look at all pieces of your planning for your family, as opposed to, or you and your wife or spouse as a minimum. But if there's really just specific corporate tax questions that you have or specific estate planning concerns that you have, we can address them on a more modular basis as well. This is just a visual of the software that we use for the cash flow projections, where we can see different events in your life, different goals you're trying to achieve, whether you've got the cash flow on the current assumptions to reach your goals. And the scenario analysis, I think, is the most important. So this screen just shows two different versions of your plan, a base plan and then a retire at age 60 plan. So maybe the base plan was retire at age 65 and the alternate is retire at age 60. But we can compare the results so that we truly understand the impact of different decisions that you might make in your planning over time. This is a representation of the Canadian map and the professionals that we have across the country. My team is growing every day. I recently hired in the Calgary market a strong financial planner. As you can see, we have representation in all of our major centers, including Quebec, Vancouver, Calgary, Winnipeg, and Toronto in the GTA. A few highlights that I'll share. Alicia Toe in our Vancouver office, just a dynamo, super smart, alphabet soup after her name because she's done that much work to develop her skills. Sylvia Azoulay in the bottom is an estate planning specialist and a philanthropic specialist. So if you are charitable and you want a longer term plan for your charitable goals, Sylvia is the one to talk to because there's a true passion of hers to help you with that. Sean Sue, who is our senior tax specialist at a US CPA. He's our cross-border specialist. Ryan Nipfeld, senior financial planner in Toronto, but also a CPA, so a great Canadian tax specialist. You can see, of course, Penal, Brett. Amelie Campo-Longto in Montreal is a tax lawyer. She's so smart and so good at the work that she does. Chris Curtis in Winnipeg, who is also a lawyer and an accountant. Pretty unique skill set, a super smart guy, and absolutely at your available to help you with your planning going forward.
Again, best in class resources, which is what I like to brag about.
So Lauren, maybe I can hand it back to you. I think my concluding comments are simply that there's lots of options, especially when you're an incorporated professional. It opens up doors of tax planning that the average individual, the average salaried employee does not have at their disposal. So make use of those things. But we can help educate you and identify the strategies that fit for you. Second of all, don't ignore your family. I worked with a family recently where the father was the patriarch, had passed on. Mom was not involved in the practice at all. The children are young and frankly immature and at a loss on how to move forward with the wealth that is being passed down to them. So don't leave them in the lurch. Make sure you've got a plan and there's professionals around to help you implement. And if we can help to drive that conversation, we're here and happy to work with Lauren and his team. Over
Thanks,
to you,
Marie.
Lauren.
And I'm just going to circle it back to the goals of this webinar series is really understanding the professional corporation, what it can do for you, why it's important to have a wealth plan, and then what you can do to invest tax efficiently inside your corporation and get some of those corporate dollars out without having to pay that high tax rate. Now, wealth planning, it's near and dear to both Maureen's heart and my heart. We've done individual presentations on just the wealth planning. So even if you didn't have a professional corporation, everybody we feel can benefit from the planning and understanding the dynamics of the family rather than learning about them after a death in the family. So by all means, again, you can go back to my library, learn about estate planning, being a family affair. But really, this is all about helping you, the incorporated professional. And I noticed, we're running over. I said it would be a 45-minute presentation, but everybody is sticking around, which is great. But Maureen, do you want to open it up for questions for a couple of minutes to see if anybody has any?
Absolutely. Bear with me 1 second.
So I think Maureen's going to try or if you can put up your hand, there might be an option within your WebEx and
I,
see if that works so we can unmute you.
I think I have unmuted everyone, hopefully.
This is always a little tricky. But I don't see any hands up.
I'm just gonna, oh, it doesn't want to let me. Yeah, unfortunately, it's not going to let me unmute everyone at once.
So what I think I'm going to do is maybe wrap it up here because we're running past due, as I mentioned. But I really want to encourage anybody who has any questions to reach out to me directly, and certainly I can connect us to Maureen or who the right person might be within the tax and estate planning department. For those of you who signed up, I don't know. I'll be reaching out and I'll be sending a recording and just introducing myself and a little bit more about my practice and the last session as well. And lastly, hopefully you'll join us in a month, November 23rd, for the investing side, the tax smart investing inside your corporation. I think it'll help put a lot of what we learned today together to feel comfortable moving forward on the majority, if not all aspects of your professional corporation. I mean, you've got the hard job to earn the money, and my role is to help keep that money as tax efficient as possible and to grow it as tax efficient as possible. So with that, I'm going to thank you, Maureen, for another great job. And thank everybody again for taking time out of their busy schedules. And I look forward to talking to everybody who participated in the very near future.
Fantastic. Thanks so much, Lauren, for the opportunity.
All right. Take care, everybody. Bye now.